I recently concluded a program on private equity fund accounting for a very large fund administration company. And the question that popped up during one of the Q&A sessions was, what is the difference between capital commitment, capital calls? Why is capital in calls? Why isn't it collected at one shot? Like, for example, if a company does an IPO, it collects all the capital from the investors most of the time at one shot. But in the case of private equity fund, they don't actually collect all the capital, they collect it in calls. So, what is the meaning of this calls? How does it impact the performance of the fund, etc.? Hello, everybody. I'm your learning partner, Sushila Hariharan, with over 15 years of capital markets training experience for large investment banks and fund accounting companies. I urge you to subscribe to my YouTube channel if you're interested in a career in global markets, in equities, foreign exchange, or even in interest rate products across operations, regulations, and settlements in the dimensions of fund accounting, OTC derivatives, and trade life cycle. In this video, we're going to clearly discuss about the need for having capital calls. Let's say there is a limited partner, KH Fund, which has invested in Hari Hedge Fund, which is a general partner. In this very simplistic scenario, I've just taken one single LP, but in most cases, there would be at least 10 to 12 LPs. In some cases, I have seen there are over 100 LPs, and in fact, the process of LP paying in capital is also fully automated as per the software that is available nowadays. So, in this simplistic scenario, there is one LP, which is KH Fund, and there is one GP, which is Hari Hedge Fund, and KH Fund has invested into Hari Hedge Fund, and the defining terms and conditions of the relationship between the LP and the GP is mentioned in the limited partnership agreement. This LPA is the basis of the relationship between LP and GP. The limited partnership agreement varies from LP to LP, but it will be standardized for the GP. This is simply because of the terms and conditions with reference to the capital calls that are there with respect to the LP agreement. So the LP agreement will clearly mention what is the committed capital from each of the LPs. The committed capital is what the LP commits to contribute into the GP. Okay, so this is a very important part to understand, that committed capital is the capital that is committed by the LP, by each and every LP to the GP, and this has to be documented in the LPA. Okay, in case there's any dispute, or in case there is a requirement to go back to the terms and conditions, this committed capital is the basis of payment of management fees, is the basis of payment of performance fees, and therefore committed capital terms are to be mentioned in the LPA. The capital call schedule also is mentioned. Now, this cannot be the precise dates because the GP is going to call for the capital only after they have identified the investee or the target company, right? That could take any time between 3 to 7 years, right? And the capital is collected from the first year itself. And if the identification of the target company, the terms and conditions are decided, etc., all that takes time, and therefore the schedule could only mention the months or only mention the years, or it could even mention just the number of drawdowns. It need not mention the exact date, and obviously, because it's not possible for the GP to come up with a precise, exact time bound date on which they can do the investment into the private equity target company. The Why is capital contributed on multiple days? So this is a question that Praveen asked me actually in the training program, and the reason he asked me this question was because he has seen that there have been reasons attributed which are multiple, given in many websites about why capital is contributed. So capital is contributed, let's say, in multiple dates. Why? Let's analyze why. So let's go directly into an example. Let's say Hari Hedge Fund, which is the GP over here, has received commitments from multiple LPs. And the total sum of the capital that is committed by the LPs. The LPs have only committed the capital. They have not paid in the capital yet. Please remember this. Okay? The LPs have only committed the capital. They have not yet paid in the capital. So when the fund has received commitments of 100 million, and let's say on 1st of January 2020 they have identified one company which is a target investment worth $10 million. That's still only 1/10 of the commitment that they have received, right? That still leaves the hedge fund with 90 million more dollars to invest into different companies. And on 31st March 2023, a good 15 months later, they have identified a second target company of $45 million. So there is a long gap between the two investments. The two investments are not made on the same date by the private equity company. If the two investments are not made on the same date by the private equity fund, then the private equity fund cannot will find it very challenging to take in all the capital from the LPs on the same date. So see the gap between the two illustrative gap between the two investments that are made in the two target companies in private equity. There's a good 15-month gap, and that gap is very, very long in some cases. It's unpredictable. In some cases, it could be 6 months. In some cases, it could be simultaneous. In some cases, it could be more than 6 months. That time taken is very, very different. What happens if Hari Hedge Fund, this is another question that came up in the program, collects all the capitals from all the LPs on a single date? Okay, let's say the private equity firm the GP has collected all the capital from the LPs on the same date. What happens then? It's difficult. It's time consuming for the GP. It's expensive for the GP. It could turn out to be prohibitively expensive to collect all the capital and not invest it, right? In some cases, the GP collects 100 million but earns only on 10 million. Okay, this could be misinterpreted as an underperformance, and the alpha of the private equity fund manager could go down, and they will not be able to command the performance fees or the carried interest that is their entitlement. So therefore, keeping all this in mind, the fund collects capital only in stages. A very simplistic example, let's take the case of a single LP. Okay, of course it's not the reality. We'll be discussing in the next slide the reality of multiple LPs. Okay, let's say the total capital commitment by the P fund is $100,000. Okay, at the time of signing the LPA, that is the limited partnership agreement, the first call comes in. In this case, this is $20,000. That means the total paid in capital is $20,000, and the balance that is left to be paid in is $80,000. Okay? Now, this balance need not come in immediately. All right? The GP identifies the second target company. All right? And when the second target company is identified, it makes a call of $55,000 because the investment is much larger in size. That means the total paid in capital is 55 plus 20,000. That gives us $75,000. The LP has to still contribute the balance, that is 25,000. Let's say the final call happens of $25,000. The total paid in capital is now $100,000, and there is nothing left to be contributed by way of capital by the LP. What happens if the fund has got 3 LPs, which is what is most likely the reality? How is the capital call made? The first instance is, let's understand this table perfectly, okay? The committed capital by LP1 is $100,000. The committed capital by LP2 is $500,000. The committed capital by LP3 is $400,000. The GP has totally collected $1 million from these 3 LPs. Let's say the deal size is $200,000, okay, of the first company, of the target company. Before making the investment of $200,000 into the target company, the GP sends out capital calls at least 14 days before the investment date to the LPs. The capital call goes out of 20,000 to LP1. Now, how did I arrive at 20,000? Since LP1 One has a committed capital of 100,000 of a total of 1 million. That's about 10% of the total corpus. Out of the deal size of 200,000, they will contribute $20,000. Similarly, LP2 will contribute about half of the total contribution. So out of $200,000, the call will be made of $100,000 to LP2. And the third and final call will be made to LP3 of $80,000, again 40% of the total contributed capital. Thus, different call amounts go to different LPs as per their investor allocation principles mentioned in the LP agreement. The total capital that is called now is $200,000. This leaves a balance of about $800,000 prorated according to $80,000 for LP1, $400,000 for LP2, and $320,000 for LP3. This system is called as pro rata system of allocation. What happens if Hari Hedge Fund sends the capital call but the LP fails to make the payment? Oh, this is not good news at all. There could be a loss of equity in the fund. The LP could sometimes lose the allocation because the allocation could then be given to another LP in the same fund or a new LP altogether. That is called as loss of equity. There could be loss because of the loss of equity, loss of rights in the fund, and there could be very severe interest charges that are paid by the defaulting LP to the GP. This is all very expensive, time consuming, and therefore, unless it's absolutely impossible for the LP to make the contribution, they otherwise go ahead and make the contribution. Thank you everybody for watching this video. Bye for now.